last thing on your mind. Keep your chin up, hey mate. Life goes on, doesn't it? But sorry for your loss anyway. Well, yes, good morning, guys. How are you guys doing? All right? Steve,
okay.
Steve's here as well, is he? Maybe.
Yeah, good man, good man.
He's just recording.
Tinkering in the background.
He's still pretty sick.
Oh dear.
Yeah.
Best wishes to you, Steve, if you're listening.
I hope you're getting better soon, mate.
Recovery. Oh, what a show! What a start!
Oh,
yeah.
Carry on.
Right, come on, let's back up.
Right, let's call it a day. See you tomorrow.
Yeah, definitely. Right, so, on with the show we go. Right, let's start with Japan. Some fantastic news for the Bank of Japan. Apparently, they now own more than 100% of their own debt. This was a story that's come out via Bloomberg that due to the way they're doing stuff over there, the Bank of Japan actually owns more debt than is actually been issued. Now, how is that possible, you may ask? Well, obviously, the Bank of Japan are buying lots of debt. They also lend that debt out as part of their operations. And then, funnily enough, they actually buy some of that debt back from the people they've lent it to. Gives you just an idea of how bonkers the situation is getting over there. So it's really an accounting measure where they actually got on their books officially more than what they've actually bought, more debt than there actually is. But as I say, it just highlights the crazy situation they're in Japan. And at the moment, there's no signs of that stopping. What do you make of that, guys? It's crazy, isn't it?
Well, the question is, if they're lending it out and then buying it again, surely they're lending it out at a worse rate than they're buying it afterwards, right? Otherwise, the person who has borrowed it from them wouldn't give it back. I mean, I don't know. I don't know what to make of it, but all this creative financial engineering that central banks are doing just to keep things in check just scares the crap out of me, seriously. I mean, the way central banks have been pretty much dictating price for many asset classes scares me. And I think at some point there's going to be proper price discovery. And that's where the poop hits the fan.
You know what it's like, Stel? It's like if you wanted to buy a car off me, okay, I'm selling you a car, but you borrow the money off me to buy the car with. So I've not got the car and I'm down the money, and the money I've got is my money anyway. It's bonkers. Absolutely bonkers. Okay, what do you make of it?
It's Bloomberg rehashing something that's been going on for a week. Just to clarify this, there's already for one of the bonds they own like about 115% of it or so. No, it's just MMT, mate, and monetizing the debt and keeping things in control. And what more do you need? And it's unless the new Bank of Japan governor is changing stuff, it's going to continue. Perhaps not at the same rate, but Japan, we've been saying it over the years. They trapped themselves, and they are now firmly trapped. So I think it's just not. Well, I mean, as I say, it could diminish a little bit, but then they are going to put the government's finances in jeopardy. And so what can they really do unless saying like, okay, I mean, we stop everything and and sort yourself out, including your own government, and the markets just implode in Japan.
Exactly.
It's good. It's good clickbait, but it hasn't really. It's not a big change of what was going on over there. So. For the
no, I think it's just the numbers. You know, other banks, other central banks do the same. They lend out their collateral, their holdings, except that other central banks don't own over half their own government bond market. So that's where the difference is.
They totally strangled their own bond market. We can argue and discuss about whether it's correct, whether it's bonkers, whether it's something that should not be done. And I wouldn't say that other central banks take a leaf out of the Bank of Japan's book, but into certain degree over the pandemic, we have seen other central banks do approximately similar to a lesser degree. But I think in Japan it just and it's been going on for a very long time, and then it's been unfortunately for one, it's been massively ramped up after the big quake in 2011, and then since then they just went on to the same path and aggravated their own situation. So I don't think it's gonna change much, but over 100% of some bonds is something never seen historically anywhere else.
Yeah, definitely. And speaking of the potential new Bank of Japan governor, another ex-official has popped up saying that the new man or woman is likely to move away from special stimulus. PM Kishida was also out with some other words on the new governor and said we'll appoint the next governor based on the candidate's aptitudes, and the decision will be made while watching future economic trends. Which is maybe a little bit of an interesting comment, because that would tend to think perhaps that depending on what the economy is doing, it may mean we get a more hawkish candidate in the hot seat. So one to obviously watch over the next month or so. If we get something in February, at least knowing who is in the line to take over. While we're at the government, the latest economic bulletin, Japan cut the overall economic view in January for the first time in 11 months. They see the economy recovering moderately, but some weakness has been seen recently. That's a bit par for the course of what we've seen in the data. Even if you take the PMIs that we saw overnight yesterday, you know, a bit of a divergence between manufacturing and services. That's what's happening in Japan. There's some data going the right way. There's some data not quite going the right way. The general trend is still edging higher overall, but obviously it's not a straight line. There's little bumps and troughs in the road as we go along. Another government official was citing Kuroda, said that the Bank of Japan will resolutely keep its monetary environment easy. Just refreshing some of his remarks. The big data overnight was in inflation, and Kiwi and Aussie inflation. There you can see quarterly numbers for New Zealand, year on year 7.2%, same as last month, but was expected to dip a tick. Again, quarterly number as well, beating expectations, but not as high as or the prior quarter, I should say. Australia was even bigger surprise. Come here, there we go. So we get the quarterly number and we get a December number there too. The quarterly numbers year on year 7.8%, beating expectations much higher than expected. The quarterly number 1.9%, again beating expectations and higher. There was a December number 2 for CPI year on year, came in at 8.4% versus 7.7% expected, and a prior of 7.3%. So that's a monthly reading there. So big jump in inflation there. No surprise to see the Aussie dollar reacting to that. All fine for me. I got knocked out my little short attempts yesterday, and I was also short a little bit of Aussie yen as well, which got knocked out in that move as well. But good news for my core longs as we ramped up into the 71s. Looking a bit iffy as to whether we're going to hold up there for now and keep this break. Those fibs there didn't do an awful lot over the data straight the way through. They're not doing an awful lot on the way down at the moment. This last area, 70.65-ish, might be a bit of a line in the sand for this break point. If we get back under there, we might go back in the box down towards the 70 area and see what happens thereafter. But on the whole, both the Kiwi and Aussie inflation looking a bit stubborn at the moment. What's that done for rate expectations? It's obviously firmed up the RBA expectations for a 25 pip hike, though perhaps surprisingly it hasn't shifted the balance between maybe a 25 and a 50. We're still pricing a 25 and leaving rates unchanged. 25 pip hike is currently 76.8% probability. The balance 23.2% for leaving rates unchanged. For the RBNZ, there we're pricing a 50 and a 75 here. 87.8% probability of a 50 and 12.3% for pricing a 75 basis point hike. What do you think, guys? We've had a little bit of a dip in inflation there. Now it's jumped higher again. Is this something we're going to see elsewhere happening, or is this a one-off?
This is surprising. Did not expect that, to be honest. And it's for both the Aussie and the Kiwi, right? For New Zealand and Australia. So I don't know what to make of it. Is it a, is a dip over inflation? I personally don't think so. Definitely not for the US, but yeah, I'm very surprised. Again, having said all that, you can never have just a straight line upwards or a straight line downwards. So it could be a bit of a, correction in some way, but I have to say it's surprising. And also it's surprising because it beats by a margin. It wasn't like, 0.1 higher. It was more. So I'm surprised. I don't know what you guys think, but actually, no, New Zealand was 0.1 higher year on year, but Australia was more. I don't know what Kay thinks, but I'm very surprised about that.
I mean, you look at the chart, maybe, we haven't yet seen the top for Australia.
Yeah, that's true.
And, if you look, compare this, let's go in a bit. There we go. Let's keep it at that. If we look at something like US inflation, it peaked last July, I think, and has been creeping down since. It seems like we've not given up anything at the moment, and potentially we haven't found a high yet. We know that the RBA has been talking about slowing. Maybe this gets them to speed up a bit, or at least keep going longer. What do you make of it, Kay?
Yeah, I'm not sure whether it's already it's early, right, to see those Chinese reopening effects in Australia.
Yeah.
But yeah, same comments as the others. Were probably a bit surprised, but I'm not sure if it's going to last. If it's I'm really not sure. Fact of the matter is that Aussie got a serious lift on the back of it, and again, a lot of it seems to have to do as well with Aussie Kiwi, where the divergence is now really back in play in favor of the Aussie this time. Yeah, I think the market, as Stella was surprised. I think the whole market was surprised, testifying the jump we saw in the Aussie dollar. So yeah, I don't have much more to say about it.
No, I mean the reaction has been much more subdued in the Kiwi than it has been in the Aussie. Obviously, size is a factor when you measure the two countries together. And that's one thing you have to consider when looking at things like the crosses. It's the same with Euro sterling. The Eurozone is a much bigger entity than the UK, so monetary policy moves there are going to be magnified more so than what happens in the UK, and that can play into the crosses. But as we said at the start of the year, I'm expecting the crosses to have much more input or be much more volatile than some of the majors throughout at least the first 6 months maybe of this year, because we're going to get all these central bank divergences playing up. And Aussie Kiwi is a key one to see that happening in effect. Right, moving on. S&B's Schlegel said they cannot rule out further rate hikes at present. A bit of a repeat there, and that it's too early to sound the all clear for Swiss inflation. The German government is expecting the economy to grow by 0.2% this year, which falls into the conversation we had on the show yesterday about how, and the three of us all pretty much agree that growth isn't going to be excessively bad or excessively good potentially throughout this year. We're going to be flatlining a bit. I think if economies get 1% growth this year or don't get -1% growth this year, they'll take that as a win. But it's looking like we're going to be flatlining for the foreseeable future. That's been borne out a bit by the IFO this morning from Germany. A little bit better on some components, a little bit worse on others. No real big trend coming in. The main assessment coming in a little bit softer, not as high as expected, but business climate ticking up, expectations going a little bit higher. So it's a little bit mixed. We're not seeing anything really taking off as far as some of the numbers coming out of Germany, at least. ECB's Panetta said we should not pre-commit to any specific policy moves beyond February. That was speaking to Handelsblatt. So one of the less hawkish among the ECB members. We must be getting close to hearing from all of them this week, I tell you. Also said can bring inflation down with well-calibrated non-mechanical rate hikes, and that it's best to reassess the policy outlook in March based on the new projections. Always looking for new projections, them lot. Can't do anything off their own bat. ECB's Simkus said should continue with half-point rate hikes. He's firmly behind Lagarde waving the flag and saying that reaching the peak rate before summer may be unlikely. So more hawkish from that. Fortunately, these bods go into blackout tomorrow, so they all shut up. But going on the comments we had so far, the dovish members are really pushing their case and the hawks are really pushing their case, and it's all setting up potentially for a lot of differing views at the next ECB. Now, what I think is going to be the main swinger, we pretty much know that a 50 is nailed on. What's going to be the real kicker is the level of possible dissension or the level of agreement between the hawks and the doves as to the next policy moves. If we're going to start seeing a big fight from the doves in terms of continuing with these 50 pip hikes, it may put a little bit of pressure on rate expectations on whether those 50s will actually get done that the Lagarde has pretty much promised. So for the ECB meeting, when it comes, it won't be the announcement itself per se in terms of the rate hike. It will be what the discussions were like. And bear in mind, we usually get sources popping out not long after saying that who said what and who was against what. So it all goes into the mix when we're dealing with the ECB to come. Right, two surveys, one from Reuters, one from Bloomberg on the Bank of England. The Reuters poll, economists expect the BOE to lift rates 50 pips in Feb to 4% and then finish with a 25 pip hike in March with rates peaking at 4.25%. Bloomberg survey think that rates will get to a maximum 4.5%, but that traders are already pricing in a full 25 pip cut by the year end. So not long after rates go up, they're going to be coming back down again. What do you guys make on that? All over the shop for the Bank of England, really.
I think any occasion that Bailey will get to be dovish, he will use it. That's
that's the standard.
That's been the case for over 10 years now, right? But the last couple of Bank of England chairman, and
I don't know. I mean, what's the other guy again? The Canadian.
Mark Carney. Come on, he was as dovish as he could be, right? I know there was this Mansion House. Remember this Mansion House interview, Mansion House speech that he was hawkish, but that was once. Anyway, don't remind me of Carney. Oh my God. Yeah, the Bank of England, they're going to be, I mean, we already have dissenters, and like you said, it's going to be who pulls the most weight. But for me, having traded the pound for so long, it's almost like a trend that every time they can, they will be dovish, and I don't like that. But that's where my money would be. Let's put it that way.
Yeah, definitely, mate. And just a quick question there from I've lost it now. Where's it gone? From Michael. Why is Aussie Kiwi bid today when there's a divergence in rate expectations? Australia to rise 25 and New Zealand to rise 50. Is this a catch up? So there is obviously a bigger divergence. Current rate in Australia is, where am I? 3.1%. In New Zealand is 4.25%. But again, you've got to think of that size factor between Australia and New Zealand. There will be potentially a bigger gap opening up, you're right, which on paper should be more fundamentally towards the Kiwi over the Aussie. We're not seeing that. And I think it's just two things. Again, it's the size. It's also this data is much bigger. This was a much bigger jump in inflation in Australia than it was in New Zealand. The trend for that inflation is still running higher. The market suggesting that the RBA will maybe have to step up its hike size, or at least go for longer. And then that will further close the gap between Australia and New Zealand potentially. So the bigger shock was to Australia than it was to New Zealand today, and that's what we're seeing in the market there at the moment, in my opinion. Right, let's look at some of the other bits and bobs. We had some PPI data, inflationary data from the UK, pretty much following the trend that we're seeing in prices generally. Numbers coming down from last month, worse than expectations, as you can see there. So the trend of inflationary pressures from the UK also ebbing, but still running at fairly high levels, as you can see there from the numbers. The US yesterday, we got their manufacturing and some services data via the F.A.C.E. The F.A.C.E. is not usually on much calendars or any calendars, but it's out every month. I'm not sure why it's not on a calendar, but there you go. So the S&P Global Manufacturing PMI, a bit of an improvement, but still well in contraction. So a little bit maybe of a dead cat bounce there. Services as well, a little bit of a bounce, but still well in contraction. So maybe we've stopped the rot, who knows? But the data still isn't looking all that hot in the US. And as I said, those Philly Fed services came in less worse than last month. The headline number -6.5 versus -12.8 prior. The key components, wages and benefits, were up to 46.1 from 45.2 prior. Employment rose as well, 16.5 versus 5.4 prior. So a little bit better there, and some higher inflationary input, and employment not looking as weak as it was a month ago either. On top of that, another smaller number, one of the regionals, Richmond manufacturing, much worse than expected and down on last month too. That's all I've got from the headlines. If I've missed anything, I'm sure the guys will have it, and now's their chance to throw it in. Got anything, guys?
No, I think if
Nope.
said everything.
Got it all. Got it all. Good. I like it when they've got nothing to say. It means I've done it all. Right. So obviously the big event today probably going to be the Bank of Canada meeting. So I'm going to get the guys' expectations for this. We spoke about it a bit yesterday. I'm not expecting any fireworks from this one. We know likely what they're going to do. A hike of 25 pips to 4.5% is likely. They've been seeing the data pretty much doing the same as everywhere else, particularly inflation, just, drawing lower a bit. Jobs market has been fairly solid as well. No massive upsets there. It has been a bit volatile now and again, but nothing really of note. The rest of the economy chugging along. So really, again, it's probably not about the hike itself and the size of it, unless it's doesn't match what's expected, but more so what the bank view going forward. We know they're in a slowdown as far as hikes go. They feel they're near the end of their hike cycle. We may get further indications of, are there going to be any more, or is this the last one, and the pause, and how long the pause is for. We do get, I think this one's got a monetary policy report with it, hasn't it? I'll have to double check that, but I think there's it has, yeah. So we're going to get a press up.
It's actually a relatively interesting one, because they could signal a pause at least, or I think it could be an interesting one, and perhaps more interesting on what they say for what's going to happen than what they actually do today. Yeah,
just exactly what I just said, actually. So what do you think for the loonie here? I'm going to be watching this low area. That might be a bit of a stretch point if they're mildly hawkish, or at least indicate that maybe they've got a couple more hikes in the pot to go yet. That's going to be one sort of area. Do you guys see anything big moves coming from this one though? And if so, what are you looking at? Any levels you're picking out?
Okay, what do you think?
Well, yeah, I put up a couple of levels in the chat room this morning, and I'm in particular going to scrutinize what happens on the EuroCAD perhaps, and maybe CAD yen if we see big moves. Because on the EuroCAD, we still have that big level up in the 146s, which some of us have been trading off. On the dollar CAD, it's a bit of a difficult call for me, to be fair. I don't know, but yeah, I think it's anywhere 50 to 100 points from where we are. There's interesting zones on the dollar CAD. But
yeah,
I'm having trouble to see a clear direction in the dollar right here and now. Yeah, it's probably going to move in tandem with other stuff. But I'm rather looking at the cross side than the dollar CAD side personally.
Yeah, well, I'll be keeping an eye on dollar CAD. I think up towards that 135 on the top side might look a bit interesting. It's been a fairly decent level up towards there, and it's from where we are now, 130 pips away, 120 pips away. That's well within reach. Same as that downside level. So at least two decent levels to look at. If we do get a decent move either side, those will likely be my stretch points. If there's nothing massive in the news or whatever they say to suggest that we're going to see rates moving more significantly, or stopping and even going the other way. So factor that in when you're looking at it. If you've got any ideas on CAD yourself, guys and girls in the chat room there, please let us know in the comments. Happy to discuss it. I would say that I think oil is a bit CAD is a bit detached from oil at the moment. Oil's just coming back off its little run higher that we've seen, and we're not seeing the loonie go the opposite way, i.e. CAD weaken on that. So for now, I think, particularly over the BOC, if you do look at oil for its relationship to the loonie, then maybe we're off that bus for the moment. Right, let's have a little look around at what's going on. Obviously, Aussie dollar, as mentioned previously, the inflation kicking it up, which is very nice. Thank you very much for my core long position. We've got a couple of zones coming up in the 71s that could be the next areas where we run into a bit of trouble. We've got one sort of 30-40, 71 30-40, which was the prior highs we saw back in August. That was after we had a decisive break through the sort of 72 area. up towards that 72 area, there's another zone, 71.66 to 80, coming in just before the 72s. That's another area I'm looking at. That's one I'm potentially eyeing for a cut of my longs. I'd like to get it up to 71.99 just to knock off 1,000 pips on my lowest entry, which was down here at 61.99. So I don't want to be a dick for a tick and it get up to 80s and I don't bother taking it, trying to be greedy for an extra 10 pips. So that's a zone I'm potentially going to be looking at to take some off, but I will be monitoring this zone to see how we do here. But for now, the trend remains my friend, at least. If we do get a big break up, the next area is going to be up into the high 72, 73s, and a lot of action seen around that zone there. So that's going to be a real potential big one, because we had several goes at trying to break it. The breaks gave some decent pips. Then it became resistance. Then we messed around. Then we had another break. And as you can see, the final break led to all the way down there. So it's going to be a big area. So if you are riding longs and you get the break up, that's one you're going to be looking at. Above there, you know, maybe the sky's the limit and we're heading back up to the 75s. But we'll take one step at a time. I'm looking forward to this one, folks. Euro sterling having a little bit of a nudge higher. Again, I can't really read much into this. You know, when we're creeping back up towards these highs, but not looking like we're racing up there. This is the area up to the 89s that we've been waiting to break. It's been a bit like euro dollar around this 108 zone, 109 zone. We get up there. We've had a couple of goes at trying to break it. We can't break it. We're not dipping too far back from it. So this whole area up here is still in question. And you take a bit of a longer view at that, look at the daily. You can see we are still in a pretty tight range, you know, 200-300 pips between sort of 88s, 86s, maybe down to 85s. Been doing that for several months now, so we need something to kick us into gear. If we have another look up here and it holds, then maybe we're going to get a steeper pullback, maybe even through the 87 and a bit lower. Obviously, central banks coming up, both the Bank of England and ECB, could be a bit of a mover for this one, but we're going to be watching the levels. And if we get through both meetings and we haven't broken significantly either up or down, then I think range play is the way to look at this one, and just play the edges, try not to get caught around in the middle. Guys, you got anything you want to chuck into this one? I've not really got a lot to add to any of the other pairs that are not doing much at all, like dollar yen. So I'll throw it over to you for your thoughts.
Well, for me on the euro pound, it's still pretty clear. Those highs are really the breakout level, 89. What is it? And then if we break that, I think it's 90 very, very quickly. And that's the level where I'm going to be looking to reconsider. I've had the bullish bias. I took out my longs a week ago or 10 days ago, roughly at these levels. It was a good run. I was a little bit scared by those headlines that said that there might finally be closure on Brexit and Northern Ireland and all that. So I said, you know, this could easily go a couple of hundred pips below. You know how markets move. Yeah, I got sucked in. I mean, at the end of the day, you know, we're still here. So, but
well, you made the right move at the time, because that's when it pulled back after that. So
yeah. should have bought it back at the 50 DMA, but I chickened out. Anyway, but yeah, I think euro pound is stuck at the moment, same as the euro dollar is still trying to break above 108.7 and break and hold. It's broken twice and come back. So as I said yesterday, we're kind of in no man's land, still in limbo, waiting for the Fed on the 1st next week, basically. And I must admit, again, these inflation numbers in Australia and New Zealand kind of surprised me, because I really think that U.S. inflation is going to surprise to the downside, and I think it's going to surprise in a big way. And I know I sound crazy when I say that, but remember they've changed the calculation, etc., etc., etc. So just my feeling that we are on the US side, we have a little bit of more surprise to come and but potentially more pain to come for dollar longs. I mean,
Yeah.
but yeah, otherwise the other pairs, I don't see anything really breaking out or doing anything magnificent. So I'll pass it over to Kay, see if he has anything.
Yeah, no worries. And just before I do that, just on this euro sterling, if we do get a break above 90, I'm going to be looking at these high levels up to 92s, 93s for turning around any longs into shorts, depending on what's going on with the Bank of England and ECB, of course. But this is been a very good range to trade up between these 90s and down into the low 80s. You know, for the last 7-8 years, it's stayed in that nice range. So it's a good range to play if you've got the patience to trade it. As you may have known from earlier last year, I was longs into here until the summer. From down below, got out 86.30s, I think, over the summer. Got back in 86.24. I'm happy to sit on those and maybe build a bit more. But if we get up to these 92s, 93s, I'm going to be looking potentially to scale in some long-term shorts, as long as it doesn't cost me too much. Kay, do you want to grab it, mate?
Hi. Yeah. Okay, let's just run through a couple of things quickly, because I don't have really much to add to what we are seeing today. First of all, dollar yen and yen pairs. I'm a small overview of the yen pairs, which, as I was saying in the chat room this morning, it seems that Asia and the rest of the world are in different on different agendas regards to the yen. It's now been twice or three times that we come in the early morning, and especially when I'm looking at stuff like euro yen or some other yen pairs, we trade around the highs and then we constantly fail, and Europe or the US puts the yen pairs back down, and this morning it has not been any different. So if you want to do like really the intraday, we already a little bit of a resistance where we stopped in the early morning hours here around the 130, 55, 60 on the dollar yen. Bit of a support here that has been holding so far in the morning, but I would not attach too much importance to it because the yen really still living its own life. Again, as I said, it looks that we are on different agendas between what's happening in Asia and in Europe. We can see it on the euro yen as well, coming in on Monday at the highs, and coming in then in the evening. Again, we are going to test the highs. Yesterday, again this morning, very early days, we coming in around the highs on the euro yen, and again we are failing. So we've got to keep an eye on what's happening, not only price wise but also price action in different time zones. I think it's an interesting watch at times. Asia moves getting undone, or Europe having different IDs on the yen pair. So just to show this one, I tried it again to go for the break, but I quickly gave up. I had a bit of dollar yen as well, so the one compensates for the other. But really, I'm just watching the game for the time being, because the yen is starting to confuse me just a little bit. On the day, if euro yen would fall back below 140.85.95, there may be room to go a tad lower here as well. And really the same is happening on the other yen pairs. The one interesting though is the Aussie yen. Thanks to the Aussie data, we finally managed to get back up there. But then again, around the what is it, the 100 DMA 200 DMA waiting up here in the Aussie yen, it failed. And now we are retesting the this black line here around 91.35. Under there is 93 quarters, 85. So that's the zone here of support. If that fails, it could trade lower again. But looking at the Aussie, it might just hold that one today. And the rest of the yen pairs is really no different. Quick look at what could happen on the Canadian dollar today. So I think the top side here, we have to look at 134.15.20 for starters. If that would break higher on a dovish Bank of Canada, we could be trading 50 to 100 points higher, in my opinion. There's a bit of a traffic zone here between this 133.5 and 133.25, which we should respect as the Bank of Canada comes out. Personal view is that Bank of Canada will go 0.25%, as the general view is. And then it all depends on how hawkish or dovish they would come out, or if they announce a full stop or just a pause or continuing the rate hikes. That's going to be driving the Canadian dollar this afternoon. So keep an eye out. If we start to break below 133.25 and hold below, then we could do another big figure quite easily, I think, on the Canadian dollar. Also because of the less liquidity in Canadian dollar than we have, for instance, in euro dollar or other bigger pairs. So that's this one is this euro cat that we have been watching, a few of us in the room. You can see this here, this zone of 146.25 to 146.40. It's really pretty important, and also supported by the fact that the weekly 200 DMA is still hanging around there as well at 146.30. So this is a big level here. We have already been trading short into it a couple of times. I would be ready to give it a try again with perhaps a stop and reverse above it. If in turn we start to go below the latest lows, and I've got a couple of levels here. This is probably a bit close for comfort, 145.15, but then this one may be more interesting. If it gets below 144.80, 85, there may be some acceleration for at least 100 points, or who knows, more, depending on how hawkish the Bank of Canada comes out. That for the Canadian dollar. Yeah, and then I look at especially the Aussie Kiwi. So we've seen the Aussie Kiwi here. These were prior lows and highs. We're in this traffic zone, but we are back above what I judge as a measure of strength or weakness. As we can see, when we went higher the first time in the Aussie Kiwi, we had a stop here around this 108.85, stopped right in front there. We held for a while when we came back to retest it, and then we had the breakdown. Now we just flew through it, and I think if we get a retest of that level, it's going to show up again. So on any setbacks down to this 108.85 Aussie Kiwi, I might be willing to give it a try again and monitor an extra one around this 108.25 zone to try and perhaps catch a knife if this goes back down. What else? The rest really hasn't really moved an awful lot. Euromex, I know people are watching it. We are again showing signs of capping. So carry trades may still be very much alive. I may give it a go again if we get a test up above 2050s, just for see what's happening there, if we can start to rebuild some of it. The dollar mix has pretty solidly reversed this trend line on the 4 hours, and lately we can't make it back up there. I may try again to lob some out if we get closer to 80, 95, 90 in the figure, for the time being, for as long as the market doesn't know what to do with the dollar. this may still be a decent play. And just last time showing what I'm looking at the euro dollar. So this is this red line from 2017. Again, trying, failing, trying, failing. This is the 50% of when the Fed started to pivot. And if we take the high of this move before the big dump, it's at 109.40. So 109.40 to me is the magic zone. If that goes, there's more to come. But as I was saying this morning in the room, it's a bit strange that we keep on refusing the level. Now, the question that I have is that, are the big accounts just on the sideline and waiting for it for some signal to push it through, or are they still hesitant on what the Fed might do? But it feels like this one is building up. The longer we hang around here, it's building up. For one day we wake up and it's trading 110 or 107 off again. I don't think we can stick around a very important level just for that long. I feel something should be decided around this level relatively soon in the euro dollar, and that may be the combination of Fed ECB next week. Well, likely it should give us some sort of direction next week. And really for today, Ryan, I may give it back to you, my friend.
Yeah, have you got anything on dollar Swiss?
Swiss? No.
Yeah, iron that.
Yeah,
Okay, I'll have a look at that.
I'm actually I'm seeing Euro Swiss hanging around this parity zone, but I no, I don't see dollar Swiss, and especially not if you're talking about divergences and stuff, because I'm not, as you can see from my charts, I'm not looking at RSIs and stuff like that, because I think
okay, I'll have a quick look
the market
in a minute.
can remain irrational on RSIs or whatever much longer than we can defend the position. So no, I'm not looking at dollar Swiss.
Cool. All right, I shall grab it back, because there's something I want to highlight that we've been talking a lot about in our chat room. Let me do that. And this is Aussie dollar, and I snapped this yesterday because we have been seeing very strong fix action into the London fix at 4 p.m. GMT. This is 3 days on the trot from Friday. Big reactions coming in roughly from about 3:30 in the afternoon, running all the way into and over the fix. So it looks like there's something going through there at these fix points. There has been talk that there's been stuff going through Euro Aussie at this time as well, for the last week or so. So we're not entirely sure what it is, where it's actually being done, but we have been seeing a big reaction into these fixes, and the market, particularly yesterday, is taking notice. Now, what does that mean moving forward? Does it mean we get to 4 o'clock and the same thing's going to happen? It might do, but what the risk is that the market is now seeing this. It's seen 3 days of this happening, and it's going to front run that today. Now, this stuff could be M&A flows, it could be dividend payments being done, and the amounts, or the large amount, has to be done in pieces at the fixes. We don't know what it is, but the market might front run this today. And if it doesn't get the follow through from the actual Aussie buying, it's maybe going to get out of town pretty quickly. So watch this fix closely today from about 3:30 GMT. If you start to see the price running up significantly, taking a leg up, I wouldn't look to chase that. But if you're sitting in an Aussie dollar position into the fix and it gives you a bit of a free lunch, then look at maybe that move to take some money off the table. But if there is more flows to be done, then we may see the same thing again. But the more the market picks up on it, the more it looks to front run it, the greater reaction the other way is if the market has gone too far in front running it. Do you have any idea what this might be going through in this Aussie K, or even still? Yeah.
Yeah, no, probably just money managers trying to to buy Aussie, and some using those fixings. No, I haven't got a clue. I haven't heard anything either from the market, specifically what's happening over there. And I wouldn't think it's an M&A either, because they would probably could be an M&A actually, but I haven't seen anything on the merger and acquisition front to justify this kind of move over fixings.
Yeah, I mean, I think when we see something like that, which is very precise and clearly it's flows that have to be are set on the back of where the fixing is, it has to be on the back of some kind of structured deal of some sort. I mean, obviously, I can't know what it is, but it's not just some random. Actually, after a while, like you said, Ryan, people catch on and they might play it. So basically exaggerate this move. But I think this ones that we've seen so far has to be on the back of some kind of structured deal, a big one, obviously, that has to be executed on that level. So, but obviously, I don't know what it is. I mean,
no, we'll keep part.
If I knew, I'd be on the back of it.
Yeah, and telling us after. But so we have been noting this in the chat room, and some of us have been trading it. That's why I was taking shorts in Aussie dollar, just on those fixes, and it sort of worked yesterday from the first fix, and it didn't work so much after I did back in yesterday evening, because it has been maintaining these gains, and then obviously the CPI took me out entirely of that. But yeah, keep an eye on that coming into the fix later on, particularly if you're trading the Aussie. If you're short into that time, you might want to think about checking your trade and making sure you're protected on that. And speaking of the chat room, this is where you will find out if that sort of thing's happening, because we're very quick to point out any outsized market moves going on in there in our various chat rooms. We are running a big steep discount on that at the moment, which you can take advantage of if you want to come in. You can also, is the trial still running through this period, Stel, or
no? When we have the deep discounts, there's no trial. So the trial is going to come back when this discount period is over, which is going to be just a few more days.
Yeah. Okay. So, but if you want to take advantage of that steep discounting there, then do click on the link there, and let's put that in the chat room for you as we speak. There we go. And also don't forget that we are running our traders funding program. So if you want to check that out, a lot of people in our chat room are on that. We've actually got a dedicated room in our chat room if you have any questions on that or want to discuss with your fellow traders. Some of our boys and girls, Brand's still in it, and hopefully he's going to pass his assessment soon. Nudge, nudge, get a move on, mate. But
come on, don't put any pressure. Come on.
No, I'm joking. He knows I'm joking. That's one of the good things with the program, is that there is no time limit. There is no pressure. There is no one saying you need to pass this in 30 days or we'll boot you out and you have to pay again. We know what it's like to trade. We know the pressures that traders are under, because we're all traders ourselves. So this program has been designed with that in mind, that there is no pressure. If it takes you 6 months to pass the assessment, so be it.
The only constraint is that you have to make at least one trade every 30 days just to keep the account active, which is really not a big deal. It can be a tiny trade, doesn't matter what kind of trade, just has to be one.
Yeah, and I think that's pretty much the same for a lot of brokers. If you don't do anything, they get it. Get a bit twitchy about whether you stop trading altogether. So
it can be a big trade or a Ryan size trade. It doesn't matter. It just has to be a trade. Yeah.
Oh, keep it small. Keep it small. So anyway, there's the links in there for you both. If you want to check those out, please do so. Right, quick look at dollar Swissy. A bit like K-Not one. I keep an eye on it, but I'm not a big trader in it unless there's something juicy. On the longer term charts, looks like it's playing nicely with the levels. We've got a bit of a level down into that 90-80. top side, we run into trouble up in the parity to the 101s. So for me, you'd play the range in this one. I think it was Michael who was asking about that. Let me go back to his question. Where is it? How do you see the price action? Sorry. How do you see the price action in dollar Swiss diverging for ages on the hourly? You're looking at the 93 yearly level. Let's have a quick look at the hourly then. Okay, so since we've had this bounce off the lows, it's come up quite nicely. I think this is another case of the trend is your friend, my friend, he says. You know, we're stepping up higher lows. We are getting higher highs, although this one is come up a bit short into that 93 area, as you suggest, mate. So if you do get a move up here, going to be interesting to see if it holds. If it holds again, then, you know, it's looking a bit like the Aussie in its early days when it came off the lows. So maybe you could sort of use that as a bit of a blueprint in the Aussie dollar. If you, as long as you're seeing the lows coming in and we're not breaking back below them, you go with the trend. So you got a decision to make up the 93s. If you're long, you maybe take some off, maybe think of a little short, or if you want to stay long, take some off and look to trade a break above. If you get a breakthrough initially the 80s and the 93s, you may be off to the races up towards this next area up here. So it's an open book as far as I can see. I hope that's given you my small insight into it anyway. Right. All that's left is to thank you very much for coming to the Flow Show. RA, that's some good info there. You put up about the mines in Australia, could be something going on. If you're trading the BOC, keep an eye on what the message is more so than the rate reaction, unless it's outside of expectations. That's going to be the driver there. Kay, Stel, thank you as always for your valued input.
Thank you, Ryan.
Been a bit rude to me today, mate. I'm not going to hold it against you. I'll get you back eventually. Cheers, Kay, and thanks to everyone. We shall see you all tomorrow.
Ta-da!
Bye-bye.